Alright guys, welcome back to the channel. So today I wanted to go over our options overlay strategy. It seems like we're getting a lot of questions lately on how we run this and how we are essentially using the broker's money for free. Now, we need to get the housekeeping out of the way first. This is not financial advice. This is only what we do to add more income to our portfolio. All right. Selling options has its own inherent risks. Buying options has way more risk. So let's try not to do that. And also, the use of margin can and will bury you if you don't take the time to think it through. Now, I would say right off the bat, that this is not a strategy for everybody. This is for people that want to be very cautious and create extra income. All right, this can be done with any kind of asset class you hold as long as it's in a brokerage account. Once again, to finish out the housekeeping, I would like to say doing this, the best strategy is not to do this somewhere like Fidelity or Schwab. All right, you need to go someplace that has a better margin rate. Personally, that's what I would suggest. I personally use Robinhood. We also use Public. But generally speaking, I feel that Robinhood's the best to do this on because they generally have the lowest margin rates. Now, if this is done correctly, you will almost never have to pay margin, but it will happen from time to time, even over a very short period of time. So you might as well maximize your gains. Now, moving on. So to explain this as simply as possible and not waste your guys' time, we have a portfolio of about $200,000 right now that creates income for us. Now, what I mean by income and not calling it dividends is because these are things like covered call funds that put out a distribution where the fund is making money in one way, shape, or form or another, and they create income for us. All right. So you could build your portfolio to whatever size you want. You could do this with index funds doing your 4%, but I'm going to show you how we overlay our option strategy using the broker's money generally for free all the time and create a second income. Okay. So to start off with, you need to understand that we are talking about margin. Now, margin is when you are borrowing money from your broker. In this case, we are doing what's called naked puts. All right, we are selling puts. Now, a naked put means instead of a cash secured put, which normally you have an X amount of cash on hold, and then you sell the option, the put. In this case, you're using your margin. So you're saying, I have assets here that are worth this. The broker says, that's fine. We'll borrow you money if you get assigned. And that's how it's covered. Now, I know some people are scared of margin. I know some people are scared of options. But let me tell you this. You have the money there to pay for the margin debt if something happens, okay? So I would ask you, are you scared to go get a home loan? Because that's not a secured loan and they can take it from you at any point in time. Also, are you afraid to go get a car loan? Because same thing, you don't actually own that car, all right? In this situation, you also only have to pay the interest monthly, whereas any bank loans on those, you would have to pay your monthly payment. With margin, as long as you pay your interest and as long as your assets do not fall below the value that you have borrowed, it's fine. You can hold the debt as long as you want. Now, let's move forward with this strategy. If you want to do this and you understand the pitfalls of margin like we do, then you understand that a contract when selling options or doing options is 100 shares, okay? So every contract is a block of 100 shares of any stock or ETF. Now, when you're selling a put, you are saying, I will go ahead and say if it falls below this price, I will buy those shares, that one contract, that 100 shares. All right, that is a put. And for doing that, they pay you a premium. So if there's a, say, person or a hedge fund manager sitting there going, I don't want to look bad, I'd rather pay 1% to this person that if the stocks fall this week, I can get out of them and cut off the loss and look really good for my clients, okay? These are the kind of things that people think about on the other end of what you're doing as you're selling puts. This is also a way people collect shares at a low cost. So it's good to sell options on stocks you want as well. We don't personally do that because we don't want to hold anything. Now, when you sell your put, you're going to get paid that moment you sell it. And then it's going to show on your brokerage, your margin availability is going to go down because that much money has been removed from your available balance until the option settles. Now, I sell weekly. All right. So every week on Monday, I sell my options. And then on Friday, I get to see how they turn out. I've already gotten paid my premium back on Monday, my 1% or whatever you're going for. Now, that tells you the beginning and the end, but it's the middle time. Whatever that stock does to the middle time generally doesn't matter. What happens is when the market closes Friday, where the price is at. And that price action will tell you how this is going to turn out. Now, there are only two things that can happen. One, it expires worthless. What that means is it never dropped below that price you agreed to. So the brokerage lets go of your buying power, basically unhooking your money, and charges you nothing. That's the perfect scenario. They can't charge you margin for shares you didn't own. So you just use the broker's money for free. Now, if you do get assigned because the shares drop below that price, then on Monday you will run the wheel strategy. Essentially, you own the shares now. From that point in time forward, you will get charged margin. And then on Monday, you will either sell a call, or if the market shoots up over the weekend and Monday morning, you may be able to just sell the shares out cash and start over. All right. So the exit on the whole thing is the wheel strategy. It is selling a call. You're basically saying if it goes above this price, I will sell these shares. And somebody else gives you money for that ability. So once again, you're making money on the other side of it. Now, that is your exit strategy. If you're going to do this, you need to understand that you need to do this in a safe way. And when I say safe way, what I mean is delta. All right, and I'm going to run you through an example here in a moment, but to basically explain, the delta is the inverse of the odds you're going to get assigned. That's the simplest way I can explain it to anybody. Every brokerage will have delta listed. All right, it will show you the delta. On Robinhood's main screen, they show it to you as a percentage of winning the trade. But what I want to tell you is, if you want to make sure you're not getting assigned most of the times, don't get greedy. That's how I keep from getting assigned. That's how I use the broker's money week after week after week after week for free. And I do it by going out to the 10 delta on decent stocks or ETFs, okay? You don't want to be selling on trash because it's going to end badly. I have been in bad trades and they have ended badly, yes. But the trick is, in my opinion, even if you're doing like a leveraged play, all right, stick to the indexes and stick to boring companies. Some of the ones that we sell on a lot would be Carnival Cruise Line, AT&T, SoFi, TQQQ, TNA, SSO, UPRO. All of these are just variants of different stocks. American Airlines and Ford are a good example as well. These are some boring stocks and some leveraged indexes. None of them move really rapidly. They may not have the premium of some of these other high flyers, but they also don't have the downside as bad. And if you're going out to the 10 delta on these, you are very rarely going to get assigned. And that is just the truth. And once you learn their normal price ranges and how they work through them, you will be able to execute this with zero problems. But let's jump into Robinhood. Let me show you a real world example on how to find your delta. Okay, so now we're in my portfolio here, and I want to show you that these are some of the names that I'm selling on right now. And you'll see TQQQ here, all right? Now, if we're at TQQ, And we see I have positions open. But if you go to TQQQ and we hit trade. Now we are midweek, so I'm going to go out till next week. So this is on about 8 days, let's say. Now the share price is currently at 53.36. And we're going to go down and start probably about the 89% chance of profit. Now if we pull down, see the delta? 0.10. That's the 10 delta. 0.0999. That's as close to 10 delta. The delta is going to have a point in front of whatever people say when they say delta. It's just a way to convert it. All right, so if we were to sell at this, all right, we would get between 24 and 29 cents right now per share. So 24 to 29. As far as 100 shares would turn it into $24 or $29, depending upon where you wanted to set it at. Now, mind you, that's on $46.5 put. So a $46.5 put, if you got, say, 25, you are getting over half. So on a 4-week cycle, if you're making over, say, 0.5%, you're going to make 2% on the month. But you're not going to do that on all of them. I like to mix my balance up. So I may do one of these and then go over and do a Carnival Cruise Line where I'm only going to make, 0.25 to 0.35 a week, which is less, but it all balances out. But the important part here is to go down and grab that 0.09, 0.10, which is the 10 delta. Getting out that far takes you far enough out of the money that the odds are basically 10% you're going to lose your trade, 90% you're going to win your trade. This makes it so that you can take a lot of the guesswork out of what's going on. Now, there will be market drops. There will be times that you'll have to sell calls for a week or two to get out. So there is going to be an inherent margin cost. But generally, as long as you're using quality names, that shouldn't happen very often. And when you add in using the broker's money generally for free, it's really hard to beat this strategy. All right, now we are discussing margin here. And this is the cardinal rules you have to follow. 1, never use more than half your margin. All right, at times they will give you like 3x what your portfolio size is. So my advice to anyone who wants to do this, and my advice to people that have learned to do this, working like with me, but on their own, because all I do is show people what I do. I'm not teaching anyone anything. But I always say that there's just a handful of rules. Number 1, never use more than half your margin. What do I mean by that? You have to keep track of your margin. They will give you, say you have a $100,000 portfolio. A lot of times they'll give you $200,000 or $300,000 worth of margin. All right. So if you have a $100,000 portfolio, you can only use half, which means you can only sell $50,000 worth of options. Why do we do that? Because we've never seen in any recent years a 50% drop in the market. That means you will never be put into a margin call, generally speaking. If the market drops more than 50%, you got bigger problems. Don't worry about them liquidating a share of your portfolio, because we got big problems. But with that said, you also need to get out to that 10 delta. So let me put some real world numbers together for you guys so you can kind of understand this. And I'm going to make it the most conservative numbers possible. Results will vary. I have higher numbers than these by doing some of the leveraged ETFs on the index mixed with some of the conservative ones. So results will vary. But for very conservative numbers, let's say you have a $100,000 portfolio. Let's say it pays you a 12% distribution, something like SPYI. So you're making 12% a year on your portfolio, just doing nothing. Then you turn around and say, I would like more income off my portfolio. Okay. Well, if you use $50,000 and let's say you're making 1% a month which is very conservative, very low compared to what I just showed you, then you would make another 12% a year, but you're making that on $50,000. So a $12,000 coming in from SPYI in a $100,000 account. So you got $12,000 in distributions and $6,000 on the margin, half of the portfolio, the overlay strategy. So together, you now make $18,000 a year. Now, let me adjust the numbers to be more where we are. So, as I just showed you in that example, I can get almost 2% a month. Now, I try not to be that aggressive. Generally speaking, over the year on the half that I margin, I try to make about 18%. All right, that's just the simple numbers. 18% is what I'm trying to make. Now we have a $200,000 portfolio making over 20% in distributions. All right, so that's 40 grand right there. And then you've got another 18 grand in options. So $58,000 on a $200,000 portfolio. Now, that's an aggressive stance in my opinion, because if you're just getting started, you should be even more conservative. Maybe you want to go out to the 8 delta. Maybe you want to go out to the 5 delta. And if you go out to the 5 delta, I will be very surprised if you ever get assigned. I mean, you're going to have some major pullbacks. And it's also important that when you figure these numbers, I'm telling you guys like 0.5% a week. There's 52 weeks in a year. That doesn't break down evenly over 12. So even being conservative and say you're making 1%, you're actually going to make more because there's more weeks than 4 weeks per month, if that makes sense. That's if you're selling weekly. You're welcome to sell monthly and go out to the 10 delta. That's a very conservative way to do it as well. And it's less time. Maybe you don't like managing your portfolio. But this gives you a way to understand how to overlay a second income off a portfolio that's already out there. Maybe you're thinking, I'd rather do index funds. It's a little safer. Okay, you're going to make 4% if you're using the 4% rule. Maybe you look at the newer numbers and you're like, okay, I'm doing 6% a year. Well, on a $100,000 portfolio, you're going to make that 6% a year. But you're also going to make 1% a month doing the options on half the portfolio. So you're looking at another $6,000. So, $12,000 per $100,000 is pretty good. 6 and 6. Now, I would say that anyone can do this. I'm not telling you to do this. This is absolutely not financial advice. This is just me trying to put out a video explaining it. There's a lot of caveats to this. You got to make sure you're not selling on trash. You also have to make sure your underlying portfolio is stable. You can't be holding a bunch of meme stocks. You can't have your portfolio, the underlying one, full of stuff like GameStop, because the price swings of your actual portfolio will screw with your margin. You want to have pretty good stable options in there as far as what you're holding, whether it's index funds, whether it's just, income funds. I like income funds personally because even if I have a real bad couple weeks, the income that's coming in can pay down some of my margin if I need to. And the only reason I would need to is just for my own mental well-being. I've never really been in that kind of situation, especially in the rather rampant bull markets we've run since 2020. I think that this is the perfect option to create a little more income off of a little less of a portfolio. I think that time is our most valuable asset. So this is a way to pull extra income and not have to save as long, or maybe you're working more years to try and build your portfolio so you can retire. This might get you over that line sooner so you don't have to work as much. But if you enjoyed this content, please go down, hit subscribe, hit the notification bell so you see all of our upcoming videos. Leave us a like. Let us know down in the comments what you think. Do you sell options, or do you think this is a strategy that would work for you? Also, if you are absolutely deathly afraid of margin and you think this is a really bad idea for you, say so down in the comments. And there's other variations of this you'll find, so feel free down in the comments to talk about what variation of this you do and how you work the scenario to make it work. It'll help all the people in the community, and I'll see you in the next one.